Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Welcome to the Deep Dives, your shortcut to being truly well-informed. Today, we're diving headfirst into the global financial markets. We want to cut through all the noise, give us all a clear, structured summary of what's really driving, key currency pairs, U.S. equities, and the major macro indicators. We've pulled together a stack of resources, economic calendars, market sentiment indices, deep dives into central bank decisions, all to give us the clearest picture possible.
Yeah, it's a fascinating mosaic right now. So much interconnected information out there, and our goal isn't just reporting what happened, but helping understand the why. Connecting the dots, really. We want everyone listening to walk away with a robust grasp of how recent decisions and upcoming events are shaping sentiment and market direction.
Okay, let's unpack this then, starting with the big news from the Federal Reserve. Yesterday, September 17th, 2025, the Fed cut rates by 25 basis points, 0.25%. Now, this was widely anticipated, and Chair Powell called it a risk management cut. He acknowledged evolving risks in the labor market. But, it feels a bit counterintuitive, doesn't it?
Yeah.
Growth and inflation outlooks were ticking up, unemployment outlook lowered. What's the real story?
That's exactly the puzzle, right? The narrative coming out from various market reports, it's all about shifting labor market risks. So while the surface numbers look okay, maybe even strong, there's this growing concern about what some are calling stall speed.
Stall speed.
Yeah, think of it like a car, slowing down. It hasn't stopped, but it's losing momentum fast. For businesses, this means even if payrolls are positive now, they might soon need to shed jobs to stay profitable. We could even see negative numbers. So the Fed, it seems, is trying to get ahead of that curve, a bit preemptive.
Okay. So a preemptive strike against a potential future downturn in jobs, even if today's data isn't screaming recession. That's a key nuance. Now, how did U.S. equity markets take it? The S&P 500, NASDAQ, Dow futures, they're generally green this morning, September 18th.
That's right. S&P futures up maybe 0.4%, NASDAQ up 0.5% earlier in U.S. trading. But you're right to remember that initial reaction. There was confusion, some volatility right after the announcement.
Yeah, I remember that.
It was intriguing. The market initially seemed to be looking for stronger guidance, maybe some juice, as commentators say, which Powell didn't explicitly give. Look at two-year Treasury yields. They popped higher during the press conference.
Yeah.
But then ended up trading flat by day's end, erased all that volatility. And Powell was pretty firm, He emphasized little support for a bigger 50 basis point cut. He said those big moves are for times when policy is out of place and you need to move quickly. He clearly didn't feel that way now.
And this seems to echo inside the Fed itself. I heard the dot plot showed quite a bit of disagreement.
Absolutely. That dispersion in the dot plot where individual members map out their rate expectations, it points to significant internal discord, different views. And the CME FedWatch tool, which tracks market probabilities for rate changes, it started implying 2 more cuts this year. That's 1 more than was priced in before the meeting.
Wow, okay.
So this discrepancy, it tells us that even within the Fed, there isn't one clear vision on the economy, inflation, the labor market. It's like they're navigating choppy waters with different charts.
That's a great way to put it. Choppy waters, indeed. Now, while the Fed's move dominates U.S. headlines, other central banks are facing their own challenges. Let's shift to the Bank of England, the BOE. Today, September 18th, they're expected to hold rates steady at 4.00%. But the interesting part is they might slow down quantitative tightening, QT, reducing asset runoffs.
Exactly. From 100 billion pounds a year down to maybe 70 billion. This move seems like a clear attempt to ease worries about bond market supply and volatility. The UK market, as we know, is quite reliant on foreign funding, so stability there is crucial.
Okay, makes sense.
But what's interesting is even as they ease QT, the market isn't really pricing in another BOE rate cut until spring next year. It highlights those persistent worries about inflation and wage growth in the UK, even though the growth outlook is, anemic. That was the word a major UK retailer CEO used recently.
So caught between inflation and slow growth. A tough spot.
A very tough balancing act, yes.
All right, let's pivot to Asia. The Bank of Japan, the BOJ, highly anticipated decision coming up tomorrow, September 19th. Expected rate decisions 0.50%. And we just got Japan's August CPI data. National core CPI at 2.7% year over year, national CPI at 3.1%. Japan's facing persistent inflation. That's something many traders haven't seen in their careers. How does the BOJ handle this without rocking the global boat, given the reliance on cheap Japanese money?
This is a genuinely high-stakes decision for Governor Ueda, a real tightrope walk. The market is completely split right now. Will he signal a rate hike soon? Maybe October, maybe December? Or hold off, there's a political angle too. The LDP vote on October 4th might create a sort of political window for a BOJ hike, potentially. The challenge is huge. Hike too fast, and you could destabilize global finance that's used to low-cost yen. Ignore inflation, and you risk credibility at home. Significant global ramifications either way.
Makes that BOJ decision absolutely critical viewing then. How are these central bank moves or expected moves playing out in the currencies? Let's look at Euro USD. It jumped after the Fed cut, hit 1.1920, but then dollar strength pulled it back down, sort of around 1.179 this morning, September 18th. Worth noting, though, the euro's at its strongest in 4 years.
That euro strength is largely about divergence, isn't it? You've got the Fed cutting, but the European Central Bank, the ECB, their rate's 2.15%. They're expected to hold steady. Their next meeting's October 30th.
Right.
So that yield difference attracts money to the eurozone. Simple as that sometimes. Now for USDJPY, we saw the yen gain a bit initially towards 145, but then it reversed, settled back around the 146 level.
Okay, and what are traders actually doing? Does the order book give us any clues on USDJPY positioning?
Yes, looking at the ONDA order book from around 7:30 p.m. U.S. Eastern Time last night, September 18th, it's quite revealing. We see more open sell orders than buy orders sitting at higher price points, and significantly more open short positions than long positions overall.
So, leaning bearish on the dollar against the yen.
It strongly suggests traders are positioned for potential downside, or at least looking to take profits on dollar strength there. So you have this overall dollar strength post-Fed, but then this imminent BOJ decision looming. It creates a very dynamic, potentially volatile situation for these pairs, a real tug of war.
This is where things get really insightful for understanding the market's mood, I think. Let's bring in the CNN Fear and Greed Index. It helps gauge that overall investor sentiment in the U.S. And it's not just a feeling, right? It uses 7 indicators: market momentum, stock price strength, breadth, options activity, volatility.
Safe haven demand, junk bond demand.
Yeah, it covers a lot, and it boils all that down into a score from 0, which is extreme fear, to 100, extreme greed.
So how does it work? What signals fear versus greed?
Well, think about it. S&P 500 momentum slowing down. Fear.
Yeah.
Lots more 52-week lows than highs. Fear. Trading volume drying up. Fear. A rising put-call ratio, meaning more bets on falling prices. Fear. VIX volatility index going up. Fear. Bonds outperforming stocks. Fear. Wider junk bond yield spreads. Fear. Got it. And the opposite signals greed.
Exactly. The real value here is helping us recognize those emotional biases that can drive decisions. And it's interesting because recently we saw headlines like Dow crosses 46,000, stocks hit record highs as Wall Street embraces Fed rate cut hopes. That sounds pretty greedy.
Right. So record highs driven by rate cut hopes. But maybe the underlying indicators in the Fear and Greed Index tell a slightly different story. What's the takeaway?
I think the insight is that while the market is embracing those hopes, this lean towards greed, especially when you consider the underlying concerns the Fed itself seems worried about, it suggests a classic climbing a wall of worry. For us, watching the markets, it means that while momentum is positive, maybe the foundation isn't quite as solid as the headline suggests. Urges a bit of caution, perhaps, not necessarily chasing every rally blindly.
That's a really sharp point. Recognizing that optimism might be outpacing the fundamentals sometimes. Okay, looking ahead, let's check the economic calendar, using investing.com as our guide. What should we watch for? For today, Thursday, September 18th, key U.S. data includes continuing and initial jobless claims at 8:30 a.m. U.S. Eastern Time. Then the U.S. leading index at 10:00 a.m.
And jobless claims are always sensitive. We saw that unexpected spike last week, remember? Turned out it was largely attributed to fraud in Texas, according to various news commentary. But it highlights a challenge: the clarity or lack thereof in labor market data. Bad data complicates Fed decisions and market reactions.
True. And for tomorrow, Friday the 19th.
The big one globally is the BOJ monetary policy statement and interest rate decision. That's late 10:40 p.m. U.S. Eastern Time. Definitely one to watch.
And outside of pure economic data, we shouldn't ignore the geopolitical stuff either, should we?
Absolutely not. We should keep an eye on those ongoing talks and press conferences between President Trump and UK Prime Minister Keir Starmer. Discussions about economic deals, geopolitical stances. They can send ripples through the markets, influence sentiment, affect trade dynamics. It adds another layer.
So, ramping this all up,
Yeah.
what does it mean for us navigating these markets. We've got the Fed managing tricky labor signals with a cautious cut, global central banks like the BOBI and BOJ facing their own unique pressures, currencies reacting to all this divergence. The main theme seems to be ongoing uncertainty, really, especially about the longer-term impact of these policies and geopolitical shifts.
Which leads to a fascinating question to ponder, doesn't it? As central banks perhaps aim for neutral and maybe even more cuts, how might a prolonged period of this, let's call it short-lived inflation, influenced by tariffs, supply issues, how might that reshape our whole understanding of monetary policy, its effectiveness, particularly if growth and unemployment keep sending these mixed signals? It's a complex puzzle. Definitely something to think about as we all continue to watch these dynamic markets unfold.
Indeed. Lots to consider. Thanks for watching. Don't forget to like and subscribe.